All right, traders, in this video, we are going to be talking about selling covered calls, getting lots of emails. Lee, can you please explain the covered call strategy, how it works? And especially now that the stock market is getting close to all-time new highs, is that the better time? I'm not going to say the best time, but is that the better time that you should be selling covered calls? So in this video, we're going to talk about what selling covered calls are, why do you want to do it, and how you can choose which expiration and which strike price you should choose in order to sell them. All right. So if you want to learn about selling covered calls, sit back and let's just jump right in. Okay, everyone, Lee Lowell here from smartoptionseller.com. We start with a cheat sheet here in front of you, talking about the Smart Option Seller Guide to Selling Covered Calls. Okay, let's just talk about what selling covered calls is. We'll go through the list, and then we will look at an example. If you have 100 shares of stock that have been sitting in your account from a purchase that you made long ago or last week or decades ago, you can do what's called selling a covered call against those 100 shares. You need at least 100 shares long in your account in order to sell at least one covered call contract. Every option contract consists of 100 shares. So if you have 100 shares that you've purchased of that stock, you can sell one call option contract against those 100 shares. If you have 500 shares of stock, you can sell 5 call option contracts. Okay. And why is it called a covered call option contract? Because when you sell a call option, you have unlimited risk to the upside. Okay. If you sell a call option, that is a bearish strategy. You're basically shorting the market. So if the stock that you're selling those calls on goes up in price, you basically have unlimited risks to the upside. But since you have 100 shares of stock already long in your account, it will cover any upside movement in that stock against that unlimited risk that those short call options have. So that's why it's called a covered call strategy. You've got the long 100 shares, you've got a call option that you're selling, and it's all being covered against each other. But the main reason why you want to sell a covered call is because it brings in income to your account just for the sake of having, or just because you have a 100 long shares of stock in your account. Now, I've talked about this before. My parents have, shares of stock that they bought long ago. And a number of years ago, I said to them, are you selling covered calls against your long shares of stock? And they had no idea what I was talking about. They didn't even know what that meant. And I said, you could bring in a lot more money just because you have 100 shares in your account. You can do more than just collect the dividends if the company pays the dividends. And you can do more than just waiting around for the stock to appreciate in price. You can sell covered calls, collect income, and a lot of the times that call option will expire worthless and your shares won't get taken away from you. I'll explain what all that means. But in the meantime, I just want to lay the groundwork here is that you have to have a 100 shares of stock already in your account, or you can do, follow my mouse right here, you can do what's called a buy right. A buy right is when you buy the 100 shares and sell the call option all in the same single transaction. It's called a buy right transaction. We're going to go into the broker platform. I'm going to show you how you can do that as well. All right, so you understand how it works now. You have 100 shares of stock in your account that you either had from long ago, or you do it at the same time. You're going to sell a single call option contract against those 100 shares, and you're going to collect the income by selling those call options, and that money's going to go right into your account, and then you're going to wait until expiration, or I'll show you what else you can do to see if your shares get called away from you. And you might be wondering, well, why would my shares get called away from you? Well, if you sell a call option, okay, that basically is obligating you to either short 100 shares of stock or have the 100 shares in your account get taken away from you at a higher level than where you purchased those shares, okay? So basically what we're saying right here is the short sold call option is covered by the long 100 shares, which we've talked about. You never want to sell uncovered call options. It has unlimited risk. So don't sell naked call options, as it's called, because you could lose a lot of money and you don't want that to happen. All right. So here's how you figure it out. So now you have the 100 shares. You're thinking, okay, I want to collect some more money. I'm going to sell a covered call. But options have all different strike prices, all different expiration dates. How do I choose which one, which expiration date, and which strike price that would be beneficial to me? Okay. Now, there is no one size fits all to that answer, or to that question, I should say. Everybody's different. Everybody has different thresholds where they would possibly want to relinquish their shares in the future. Now, there is a case where, yes, you may have your shares taken away from you. So if you don't want that to happen, you want to choose a strike price that's a bit higher than where you purchase the stock. And I'll show you how you can do that when we look at the option chain, okay? Now, the best case scenario is that you sell the call option, the stock doesn't move up to that strike price, you don't have to sell your shares, and then you can repeat the process for another round and sell another call option, collect more cash. And if the stock doesn't get up to that level, it expires worthless, you keep the money, and then you sell another call option for another expiration date. So hopefully what you want to do is you want to keep selling these call options. You want them to expire worthless, and then you sell another round. You want those to expire worthless. So you keep the wheel moving, and you don't have your shares called away from you, and you just keep collecting this premium income. It's a really great thing. All right. So let's talk about what else we have here. If you don't want your shares to be taken away from you, you can always roll the trade while you're still in that initial transaction. And I'll show you how to do that as well. But let's just say the stock's at 100 and you've sold the 110 strike call option and the stock's starting to tick up close to 110. You don't want your shares taken away from you. What you can do is you can roll the trade where you would buy back that first call option that you've sold, and then you'll sell another call option at a higher strike price to give yourself some more buffer at a further out expiration date. And I'll show you how you can do that as well. All right. And just know that there is risk in this trade. You've got a bullish trade here. You're long 100 shares of stock. So the risk in this trade is ultimately if the stock declines in price. Even though you're going to collect the money, the premium from the call option, that'll buffer you against the stock movement lower up to a certain degree. If the stock just drops and keeps dropping, well, nothing's going to protect you unless you sell the stock or unless you've bought, say, put options, a while ago. But there is risk owning stock, and that risk is if the stock keeps dropping. But we hope that doesn't happen. All right. So let's look at an example. I'll show you the option chain. We're going to look at some strike prices. We're going to look at some expiration dates, and we're going to figure out, which one might be good for you. And I'll show you how you can do the roll, and I'll show you how you can do the buy right as the single transaction in the broker's platform. All right. So let's just jump right in, and we're going to look at SoFi. SoFi is going to be our example here. SoFi Technologies. A lot of people are gung-ho on SoFi. It's a relatively cheap stock on a dollar basis. So there's a lot of people enthused with this stock. So here's the daily chart for SoFi. It's had the nice move since April. It's had this pullback, just in the last week or two, all stocks had this nice pullback, made for a good buying opportunity. So SoFi's right up here around $29.72. So we're going to use SoFi as our example. And either A, you have purchased 100 shares of SoFi sometime in the past, and now you want to sell a covered call against it. Or if you're still bullish on SoFi, now, if you're still bullish on SoFi and you haven't done the covered call trade, you can do the buy right. And I'll show you how to do that as well. That's where you buy the 100 shares and you sell the call option all in the same transaction. Okay, so SoFi is our stock here. Let's jump into the broker platform here. And we're going to look at SoFi options, which I already have here pulled up. So let's assume that, number one, you already have 100 shares of SoFi in your account. And now you're just looking to get some more income into your account and you want to sell a covered call. And we're going to use 100 shares of SoFi. That's all you have, 100 shares. And let's just assume that you purchased 100 shares at $25 a share sometime, in the last few months. And you've paid $2,500 for your 100 shares. And now you're looking to, get a little extra income. So what you have to do is manually go through the option chain and see how much money you can get for selling call options on your 100 shares of SoFi. Now, we're going to do this, we're going to look at a 1 week option, and we're going to look at a 1 month option and then a 6 month option, so you can see how much money you can get by selling a covered call on SoFi. Now, number one, you've purchased your 100 shares at $25 a share. So you, in your mind, have to think, okay, where would I be okay relinquishing my 100 shares of SoFi if I had to relinquish them? It's not a guarantee that you'll have to get rid of them, but where would you be okay? And you say, okay, well, I bought them at 25. I'd be okay with a $10 appreciation. I'd like to sell my shares at $35 a share. Now, this is just an example. This is not a real trade, not a real recommendation. I'm just throwing some numbers out there, okay? $35 is just an example. So what you do is you go into the option chain and you see how much money is being paid for those 35 strike call options. Here's the strike column down here, call options on the left, bid and ask prices right here. This is all we need to look at. So we go up to the 35 strike here, and we can see for the December 5th, 2025 expiration, which is, this coming Friday, you can sell those things for about 3 cents per contract, which is you would receive $3 in your account for selling this 35 strike call option. Here you see this 2 cent bid at 4 cents. You sell it in the middle at 3 cents. Someone will give you $3 for your obligation to sell them your shares at $35 a share. When you sell this 35 strike call option, what you're doing is saying, I will sell to you my 100 shares at $35 per share if and only if SoFi actually trades up to $35 by December 5th. Okay? So SoFi would have to go up over $5 per share in, at this point, 5 days from now, and you'll receive $3. If SoFi does not rally up to $35 by Friday, December 5th, you do not have to sell your shares to anybody, and you keep your $3. Okay. Now, if $3 is not really enough for you, let's go out to, let's say, the third Friday in December, which is the normal Friday expiration. Those 35 strike call options are now worth about 30 cents per contract, which is 30 actual dollars. So if you sell one of those, you'll get $30 in your account, and you still have the obligation to relinquish your shares at $35 per share if and only if SoFi gets up to $35 a share at expiration. If SoFi gets up to 100 shares, up to $100 per share, you still have to sell your shares at $35 a share. So that's why some people might not want to relinquish their shares, because let's say by December 3rd, 2 days before expiration, SoFi jumps up to $50 a share. And you're thinking, oh my God, I got to sell these things at $35 a share. I don't want to do that. I don't want to miss out on that opportunity. Well, in that case, you're going to want to buy back those 35 strike call options, which will be worth a lot more at that point. So you have to buy them back for a loss on the call option. Now, you still have your 100 shares, which you'll be making a lot of money on. So you're only going to lose money. You're going to lose less money on your call options versus how much more money you'll make on the shares. Just remember, you always have those 100 shares. So those are always going up in value, and those will go up more in value than what you'll lose if you have to buy back the call option, okay? I'll show you how to roll that in a minute. But let's just say you're thinking, okay, I want more than $30 for this thing. So let's go out to January. So what you have here is you're doing a little manual labor. You're going through the option expirations to see how much money you can get. So for January, if you want to wait 47 days now, those 35 strike calls will pay you about $1 per contract, which is $100. So now you're getting $100 for your obligation to relinquish your shares at $35 per share. Is that enough for you? Is $100 enough for you to wait for 47 days to see if SoFi gets up to $35 a share? If SoFi never gets up to $35, you keep your 100 shares, and now you can sell another round of covered calls. Now let's go out to next January. No, let's do next December 2026. Let's say, you know what, I got some time on my hands. I'll hold my stock for a while. You have 383 days. Those 35 strike call options are now paying roughly $7 per contract. That's $700 that you would get in your account for your obligation to sell your shares at $35. So now, you're giving SoFi a little over a year to rally up just over just over $5 a share, $5.28 a share. Do you think SoFi is going to be above $35 in the next year from now? Could be a good possibility. It also could be lower. Nobody knows. But you're willing to take $700 from somebody for your obligation to relinquish your shares. Now, let's just assume that expiration does come around. Let's go back to this January one. We'll use this as an example. January 2026, 47 days from now. You've sold this thing for $1 per contract. You'll get $100. Let's talk about what happens at expiration if SoFi gets above $35 a share. If SoFi is above $35 a share, the 100 shares that you purchased at $25 a share is going to give you $1,000 in profit. Okay, you bought them at 25, you're selling them at 35, 100 shares, $10 per share. That's $1,000 profit on those shares. That is a guaranteed profit. And if SoFi is at 35 or above, you're going to have to relinquish those shares. So you'll make the $1,000 on your stock appreciation, plus you'll keep the $100 here. So you're actually going to make $1,100 as your final profit. If SoFi goes up to $50, your maximum profit is still only $1,100 because you had to relinquish them at $35 a share, but you got to keep the $100 here. That's your $1,100 profit. Okay? Makes sense to everybody? Now, if SoFi does not get above $35 by January, 47 days, you'll keep the $100 and you keep your 100 shares. Now you can go out to, let's just say you go out another month from now, and you'll sell those 35, another round of 35 strike call options for, this is going out here. So let's just assume, you're going to go out another 47 days. Okay, we're looking at January again. So let's just assume you can get another $100 for that. And if SoFi doesn't get up to $35, and then those next 47 days, you'll keep that $100. Now that's $200 you've made. You still have your shares. You can go out another month. You can do it however you want. As I said, there's no one size fits all. You choose the expiration date. If you wanted to go out to next December, then you just sit and wait for a year to see where SoFi goes, but you've collected $700 in that example. Okay, so that's how it works if you have the shares from prior. Now let's talk about if you want to do the buy right, which is that's when you buy the 100 shares and you sell the call option all in the same transaction. Let's talk about how to do that. So this is Interactive Brokers, and I'm going to show you how to set up the buy right. Now, I use the classic TWS. This is very old school looking, not very high tech. Now we type in SoFi here and we click on enter. We're going to choose the combinations, option combos, smart directed. That's where it's going to send it to. And what comes up here is another box where in the strategy tab here, the drop down, it has all these different strategies you can use, but we click on the buy right, okay? Now what that means is that in the same single transaction, we're going to buy 100 shares of SoFi at its current price, and we're going to sell, let's just assume we're going to sell the January 19th, 2026, 35 call, and we're going to do it all in the same transaction. So when you click on add, it brings up this other box here that tells you what you're going to do. To buy one buy right means you're going to sell one SoFi 35 call for January, and you're going to buy 100 shares. And if you were to do the reverse, this is what you would do, but we're not doing that. We're doing this one. We're doing the buy right here. So we close out of this, and now what comes up on the screen is a combo here. You have this line right here, the 35 strike buy right, which has an empty line because the market is closed right now while I'm making this video, but it also gives you the bid and ask price for that 35 call itself. So we know, and you can see right here, let's bring this down. SoFi stock went out $29.70 at $29.72. The call option's worth about $1. So here's how you figure it out. You have to buy 100 shares, which would cost, let's just say you bought them right at $29.72. And you get to sell this call for $1. Okay, so the spread itself would be $28.72. I want to make sure everyone understands it. You have to pay $29.72 for the 100 shares, but you get to sell this thing for $1. So you subtract $1 from $29.72, that's $28.72. So in this line, we're going to click on the ask column, and it's going to give us the order to buy the buy right, and we're going to put in $28.72. Now, if I was making this video while the market was open, this empty line right here would have a bid and ask price of, say, $28.65 at $28.80 or something like that. So we'd be doing it right in the middle at our price of $28.72. So if we were to execute this trade and we were filled, it would come out to a net debit of $28.72 per share, which is $2,872. Okay, I want to make sure everyone understands how that works. If you were to buy 100 shares of SoFi at $29.72, it would cost you $2,972. But since you're getting $100 by selling this call option, it gets subtracted out. So your total net debit would be $2,872. And then the trade goes on just as if you had your 100 shares from prior and you sold a call option, in two separate transactions. You wait to see if SoFi goes up to 35 or not. If it doesn't, then you keep your 100 shares and then you can start doing the next covered call trade for another expiration. All right, so we're going to cancel out of this thing. So that's how it works. Most brokers allow you to do the buy right all in the single transaction, or if you have your 100 shares from prior, you can sell the single call option against it. Okay, that's how it works. Now let's go back to the cheat sheet for a second. I want to make sure we covered all this stuff, especially down at the bottom here. So I said, okay, if you don't want to lose your shares, so if SoFi starts ticking up and you're like, you know what, I don't want to relinquish my shares. SoFi's going up. I'd rather get the stock price appreciation. In that case, what you can do is you can just buy that call option back at whatever price it's paying that it's trading for in the market. Now it may cost you more to buy it back than what you originally sold it, and you'll take a loss on the call options, but you'll still be making more money on the price appreciation of the stock. So don't lose sight of that. Don't think, oh my God, I'm going to lose all this money buying back this call option. If you're buying the call option back for more than what you originally sold it for, that just means the stock is going up in price. So you're making more money on the stock price appreciation. Okay. Now down here as well, the risk in this trade is if the stock falls below your cost basis. Okay. If you sold that call option, that SoFi call option for $1, your cost basis is now $28.72 if you did the buy right. If SoFi falls below $28.72, well, now you're just holding on to a losing trade, a losing bullish stock position. There's nothing you can do about that. Okay, that's the risk with any bullish transaction. Now, if you bought those shares of SoFi at $25, like in the first example we talked about, and SoFi falls below $24, because if you sold that January call option for $1, your cost basis would be $24. So if SoFi falls below $24, you have a losing trade as well. That's just life. There's nothing you can do about that unless you've purchased a put option or you get out of the whole trade before it drops below your cost basis. You can always get out of these trades. Remember, option contracts do not have to be held until the expiration date. You can get out of them at any time you want. Okay? So if the stock starts to fall, do you have a stop loss on SoFi? If SoFi falls below a certain level, are you getting out? That's up to you to decide on how to handle the risk if the stock starts to drop. Different for everybody. Okay. Now, what else in here? I want to make sure we got everything. If SoFi goes, or whatever stock we're talking about, goes above your cost basis, above the strike price of the call option you've sold, your shares are going to get called away from you. Okay. The trade will be over, and as long as you sold that call option strike at a level above your initial cost basis or above the buy right price, then you're not going to lose any money. You can't lose money. That's just how it is. But the risk is on the downside. Okay, so I hope that's answered your question. I hope you understand how selling covered calls works now. Got a lot of questions about the strategy. It's a great strategy. Now, I want to show you one more thing here. If you're thinking, I know SoFi can go up a lot, so I need to pick an even higher strike price. So let's just go back out to that December 2026 expiration again. If $35, even though you'll collect $700 for it, is still, too close, you're thinking SoFi can get above $35 in a year. Let's see what the 45 strike is paying. That's paying about, let's say, $4.60 a contract. You can sell that thing for somewhere in the middle between the bid and ask. So you get $460 in your account, but now you're on the hook to sell it at $45 a share instead of $35 a share. You just gave yourself another $10 of cushion. You gave yourself another $10 of potential price appreciation before you have to relinquish your shares. Okay, so it is something that it's a personal preference. You have to decide, where am I willing to potentially relinquish my shares versus how much someone's willing to pay me versus how long, meaning expiration, am I willing to give SoFi or whatever stock you're thinking of to potentially get up to that level. Nobody knows where a stock's going to go. There's just no way of knowing. So you have to make a decision ahead of time where you would be comfortable relinquishing your shares or potentially relinquishing your shares. And if you don't want to relinquish your shares, then you just buy back the call option. You get out of the trade. Then it's done. Now you just have your 100 shares. And if the stock keeps going up, then you might made the right decision to buy back the call options. Okay. All right. So that's it for me today. Let's go to our website real quick, smartoptionseller.com. I do want to let everyone know that we are running our Black Friday sale, which ends tonight, November 30th at 11:59 p.m. Eastern Time. So we only have a few more hours before this Black Friday sale is over. I'm going to put a link with the coupon code down in the description. You got to read down in the description. And we have our services here. Our 2 newsletters are on sale. Our coaching is on sale. Our video series is on sale. If you want something free, we still have something free. The free ebook on how to sell put options. That's our bread and butter. Look around here. Take a look at these things. Send me an email. If you have any questions before 11:59 p.m. Eastern Time tonight, you can ask me about it, but I'll put all the information down here. Please read the description below because I also have other links and websites and books and things for you to look at as well. And they may have, those other websites may have their Black Friday sales also. So spend some time looking down there in the description. All right, if this video has been helpful, give me a thumbs up, give me a like, leave me a comment. Trying to reach that goal of 50,000 subscribers. Help me get to that goal. I want to make this information, this free information. I make these free videos. I want everybody in the world to see these videos. Help me get to that level. All right. That's it for me today. I hope this has been helpful. This is Lee Lowell. I'll see everyone in the next one.